Hi YouTubers, this is Kevin, your financial freedom architect. Today I want to talk about portfolio investing. I never tell my clients to invest in the stock market if they're not buying, selling, trading, holding thousands of shares at a time. Why? Well, because after you account for broker fees, dealer fees, online platform fees, trading fees, long-term capital gains if you hold the stock for over 12 months, etc. If you're just trading a handful of stocks or 100 stocks, you're not going to make any money. You're just going to waste your time and money. So if you want to play that game, it's best if you buy, sell, trade, hold thousands of shares at a time. Your return on investment will not be realized if you're only buying, trading, selling, holding a handful or a few or 100 shares at a time. Just being honest. And if you don't believe me, let's actually take the word of a man who's been doing it for decades, Mr. John C. Bogle, CEO and founder of Vanguard. This interview can be found in Tony Robbins' book, Money, Mastering the Game, 7 Simple Steps to Financial Freedom. You can pick it up. It's a good read if you want to learn about different portfolio strategies. However, I do not suggest the average client to build a portfolio if you're not holding thousands of shares at a time. So let's get to Mr. Bogle's questions. Actually, the answers. Let's see. All right, here we are. So Tony asks, what did you mean when you said there's a big difference between a smart guy and a good investor? Well, first off, investors are average. Let's start with that, says Mr. Bogle. Very simple, and most individual investors pay too much for the privilege of being average. How's that? Asked Tony. Mr. Bogle responds by saying, active management is going to cost you around 2% all in for the average fund, including the 1.2% average expense ratio, traction costs, cash drag, and sales charges. So that means in a 7% market, they'll get 5. An index fund that costs 0.05 means that you get a 6.95 return. At 6.95, you turn $1 into $30 over 50 years. But at 5%, you get $10 instead of 30. And what does that mean? It means you put up 100% of the cash, you took 100% of the risk, and you got 30% of the reward. That's what happens when you look at returns over the long term. People don't, but they're going to have to learn to do that. That's coming from a guy who's been investing for over 50 years. Long-term investment in the stock market will not yield you the returns you expect, and definitely will not lead to the income you need to sustain a comfortable and valuable retirement. Let's continue. Tony Robbins asks, they don't see the compounding of costs and compounding of fees. Mr. Bogle responds, people out there really should understand why they're buying stocks. It's for the dividend yield, and it's for the earning growth. The fact is that over the long term, half of the return in the stock market has come from dividends, and that's where all the fund's expense comes from. So think about this for a minute, Tony. The gross yield of the average equity fund is 2%. The average equity fund has an expense ratio of 1.2%. They're going to take that out of the yield. So you're going to get a yield of 0.8%. The manager is taking half of your dividend to pay himself. And this industry is consuming every bit of 60% dividends. and sometimes 100%, and sometimes more than 100%. You can see why I'm such a pain in the tail in this industry. Again, when you account for fees that may not be expressed to you or disclosed to you upfront when you're investing in these markets, your returns will be minimum. So again, if you want to pick the book up and read it for yourself, that's the most honest interview out of, I think it's 7 or 10 interviews Tony did with other portfolio managers, investors in the market. Feel free to. Again, the title is Money Mastering the Game, 7 Simple Steps to Financial Freedom, Tony Robbins. I'm not endorsing the book, but if you want to read that interview for yourself, you can. The guy is extremely honest, just like I am, and I tell all my clients, if you want to retire with enough income to live comfortably for the rest of your life, you have to invest in income producing assets, and stocks, whether they're dividend yielding or not, are not income producing assets. Businesses, real estate, etc. are income producing assets. Feel free to email me at the email below if you have any questions about taxes, insurance, financial planning, real estate, or retirement. Until the next time, are you on a path to financial freedom?